Hello, and welcome to the Smart Investor Podcast. If you are listening to this episode, it means one thing. You want to understand money better. And that decision alone already puts you ahead of many people. Let me ask you a simple question. Why do some people work their entire lives, yet never feel financially safe? And why do others seem to grow their money quietly, year after year? The answer is not luck. The answer is investing. In this podcast series, we will talk about investing in a simple, clear, and honest way. No complicated language, no fake promises, real understanding. What is investing? Investing means using your money to make more money over time. Instead of spending everything you earn, you put some of your money into assets that can grow. These assets may include stocks, businesses, real estate, funds, or other financial tools. The goal is simple. Let your money work for you, instead of working only for money. The biggest lie about money. Many people believe this lie. If I work harder, I will become rich. Working hard is important, but working hard alone is not enough. Time is limited. Energy is limited. But money can grow without your daily effort, if invested correctly. That is why doctors, engineers, and employees can still struggle financially, while investors grow wealth quietly. Saving versus investing. Saving is important, but saving alone is not investing. When you save money, it stays the same, and inflation slowly reduces its value. When you invest money, it has the chance to grow, and it can beat inflation. Saving protects money. Investing builds money. Both are important, but they are not the same. Why most people never invest? There are three main reasons. 1. Fear. People are afraid of losing money. 2. Lack of knowledge. They think investing is too complicated. 3. Bad experiences or stories. They hear about someone who lost everything. In this podcast, we will slowly remove these fears step by step. Investing is a skill, not gambling. Gambling depends on luck. Investing depends on knowledge, patience, and discipline. A smart investor thinks long-term, controls emotions, and accepts that small losses are part of the journey. There is no get-rich-quick here, but there is a get-rich slowly and safely. Who this podcast is for? This podcast is for you. If you want financial freedom, you want to understand money, you are tired of living paycheck to paycheck, or you want to invest wisely, not blindly. You do not need a lot of money, a finance degree, or special connections. You only need the willingness to learn. Money is not wealth. Let's start with a hard truth. Money is not wealth. Money is just a tool, a medium of exchange, a piece of paper or numbers on a screen. Wealth is assets, ownership, systems that generate income. If money alone was wealth, then lottery winners would stay rich forever. But most of them don't. Why? Because they have money, but they don't understand how money flows. The flow of money. Money always flows in one of two directions. 1, from you, or 2, to you. Most people live their lives with money flowing out. Rent, bills, food, entertainment, loans. Investors build systems where money flows in. Dividends, rental income, business profits, interest, capital growth. The goal of investing is simple. Create more incoming flows than outgoing ones. Income types you must understand. There are three main types of income. 1. Active income. This is money you earn by working, like a salary, wages, or freelance work. When you stop working, this income stops. Most people depend only on this type. 3. Passive income. This is income that continues with minimal effort, such as from rental properties, royalties, or automated businesses. True freedom comes from this type of income. Why the system favors investors? Here is something most people never learn. The financial system is designed to reward investors, not workers. Investors pay lower taxes in many countries, use debt smartly, and benefit from inflation. Workers pay taxes first, save money that loses value, and depend on fixed income. This is not fair, but it is real. And once you understand this, you can choose which side you want to be on. Inflation, the silent enemy. Inflation means prices go up over time. It means your money buys less every year, and saving without investing is risky. If inflation is 5% and your money earns 0%, you are losing money slowly and quietly. Investing helps your money grow faster than inflation. Why debt can be good or bad. Most people think all debt is bad. That is not true. There are two types of debt: bad debt and good debt. Bad debt includes credit cards, consumer loans, and buying things that lose value. This kind of debt makes you poorer. Good debt includes loans for investments, real estate, and businesses. This kind of debt can help you grow wealth if used wisely. Smart investors use debt carefully, not emotionally. Time, the most powerful factor. Time is more powerful than money because of compounding. Compounding means you earn returns and then earn returns on those returns. The earlier you start investing, the easier wealth becomes. Starting late doesn't mean failure, but it means you must be more disciplined. Why most people stay broke? Let's be honest. Most people earn money, spend money, and repeat forever. They never stop to ask, where does my money go? How can I make it work for me? Investors ask different questions. Different questions create different lives. A new way to think about money. From today, try this mindset. Don't ask, how much do I earn? Ask, how much do I keep? How much do I invest? How many assets do I own? This shift in thinking changes everything. A stock is not a number on a screen, a chart going up and down, or a lottery ticket. A stock is ownership. When you buy a stock, you are buying a small piece of a real business. That business sells products or services, makes profits, pays employees, and competes in the market. As a shareholder, you own part of that system. Why stocks exist? Companies need money to grow. They need it to open new locations, create new products, hire more people, and expand into new markets. Instead of borrowing all the money from banks, they sell ownership to the public. That is how stocks are created. You give the company money. The company gives you ownership. Simple. What you gain from owning stocks. There are two main ways stocks make money. 1. Price growth. The company grows and becomes more valuable. The stock price usually goes up. You buy low and sell higher. That difference is profit. 2. Dividends. Some companies share their profits. They pay part of their earnings to shareholders. This payment is called a dividend. Dividends can create regular income, be reinvested, and grow over time. Many long-term investors love dividends. Why stock prices move? Stock prices move for many reasons. Company profits, future expectations, news, economic conditions, fear, and greed. But here is the key idea. In the long term, good companies grow. Short-term prices are emotional. Long-term prices are logical. The biggest myth about stocks. Many people believe this. Stocks are too risky. The truth is more honest. Bad decisions are risky. Good long-term investing is not. Buying random stocks without knowledge is risky. Panicking and selling during fear is risky. Trying to get rich fast is risky. Owning strong businesses for many years is not gambling. It is strategy. Investor versus trader. You must understand this difference. A trader buys and sells frequently, focuses on short-term price movements, depends on timing, and feels a lot of stress. An investor buys quality companies, holds for years, focuses on value, and lets time do the work. This podcast is about investing, not trading. What makes a good company? Before buying a stock, investors ask questions. A good company usually has strong products or services, a clear business model, consistent profits, good management, and a competitive advantage. If you cannot explain the business simply, you probably should not invest in it. Famous companies were once small. Think about companies like Apple, Microsoft, and Amazon. At one time, they were just ideas. People doubted them. Prices moved wildly. Long-term investors who believed in the business, not the noise, were rewarded. Patience is powerful. Why people lose money in stocks? Most people lose money for emotional reasons. Fear during market drops, greed during market highs, following rumors, or copying others blindly. The market rewards calm thinking, long-term vision, and discipline. It punishes emotion. Diversification, the safety net. Smart investors do not put all their money in one stock. They diversify. This means investing in different companies, different industries, and sometimes different countries. Diversification reduces risk without killing growth. You don't need perfect timing. Many beginners wait for the perfect moment. That moment rarely comes. A simple truth: time in the market beats timing the market. Starting today is usually better than waiting for tomorrow. Stocks and patience. Stocks teach patience. They go up, they go down. They test your emotions. But over time, ownership in strong businesses rewards calm investors. Key mindset shift. Stop asking, will this stock go up tomorrow? Start asking, will this company still be strong in 10 years? That question changes everything.